This is level 3 of the CFA program, the topic on asset allocation and related decisions in portfolio management, and the reading on Principles of Asset Allocation. This is the second reading of 3 readings under the topic of asset allocation. And an interesting note is that these 3 readings were written by 7 or 8 different researchers. And the good news for you candidates is that there's some overlap. So even though this is a relatively long reading and we have almost 50 slides in this slide deck, we'll be able to glance over a couple of things that we learned back in that previous recording. And you'll see that as we go through the learning outcome statements. So notice we start with Mean-Variance Optimization. We talked about that before. Asset allocation, economic balance sheet. Now, liquidity considerations, we probably talk about that pretty regularly. Now, absolute and relative risk budgets, that's something new in here. But then we go to client needs and preferences, Monte Carlo. Also something new, we'll talk about investment factors, and we'll bring in the Fama-French Model again. Global market portfolio, and then liability-relative asset allocation. And we did all that in that previous recording. Goals-based, we did that. And we'll go ahead and end with a discussion on some shortcuts. That's what that word heuristic means. And then our last slide will be on rebalancing. So this is stuff that we have done in level 1 and level 2, and in this previous reading in level 3. So let's get right to it with this really good illustration. I always ask my students when I draw a graph on the board, I say, hey, where would you like to be if you were an investor? And they, of course, always say something like, oh yeah, I want lots of return with the least amount of risk. So that's what that target is there. We want high return and we want low risk. Unfortunately, and recall our discussions from the Harry Markowitz dissertation in 1952, where assets that have high expected returns and low risk are known as unattainable. You might remember that in a previous recording I called them, it's kind of a fantasy world that you just can't reach. But in economics, look at that indented arrow point there. What do investors do? Investors always prefer more expected return to less expected return, and they always try to minimize risk in the context of being risk averse. Remember, this risk aversion goes all the way back to the founding fathers of modern portfolio theory. And in its simplest sense, risk aversion simply means that investors require some compensation for taking extra levels of risk. Now, what this mean-variance optimization model, which comes directly out of Harry Markowitz, is the following. Think of investors as being the offensive linemen in a football game. And what they're trying to do, what the offensive linemen are trying to push the defense all the way back to the end zone. Well, what's happening here is that the offensive linemen have 2 dimensions. What they're trying to do is push the defensive linemen, so to speak, all the way to minimize risk while maximizing expected return. So there's kind of a 2-pronged push for the offensive linemen here. So how did Harry Markowitz do this? How does the offensive line achieve this goal? Well, you need some inputs. So you must input the returns for every asset in the portfolio. And when I give this assignment to my students, I allow them to do monthly returns. It's really easy to download monthly returns from Yahoo Finance into an Excel spreadsheet. Then from those returns, what we can do is we can compute things like the standard deviation. And then when we add stocks to the portfolio, we know from our discussion back in level 1 that the correlation coefficient is super important in determining the value and the benefits of diversification in terms of reducing risk. And so what this reading calls this are pairwise correlations. So you need returns, you need standard deviations, and you need correlation coefficients. All right, so then you have these inputs here. Let me just go back here. I hope I didn't distract you too much with my sneezing. So let's go ahead and ask ourselves the question. All right, we have these inputs, right? But we're not just freely able to do whatever we want. We have constraints, right? So this goes back to our economics days where there are scarce resources. And so this idea of a constraint, and we'll talk about extra constraints as we move through the slide deck. But for now, we have two main constraints: that our asset weights must sum to 100%. That should make perfect sense, right? If we have $10 to invest, well, we have $10 to invest. So we're going to pick some securities, and then we're going to invest that $10 and divide it up however we do it. Probably not equal weighted, but some way. So those asset weights must sum to 100%. And then in the early mean variance optimization models, including the Harry Markowitz model, what we were assuming is that all weights are positive, which means that you cannot start or maintain any short positions. Now we'll go ahead and relax that second assumption sooner or later in this slide deck. But for now, we'll just assume that Harry Markowitz is going to give us a positive weight for every one of our investments. And remember, that's not too restrictive of assumption, because, you think about it. If we have a client and we decide that there are 40 stocks that are most appropriate for this client, well, we did a lot of research. Maybe we did fundamental analysis. Maybe we did technical analysis. Maybe we considered some behavioral issues, and we decided these are the 40 best stocks. So we probably want them all to be positive. We probably think they're undervalued. So that makes sense. Now notice in the very bottom in red there, bolded, we have given all investable risky assets, the output of the mean variance optimization model is this efficient frontier. And I want you to think of those offensive linemen. They're pushing upward, right? Trying to get lots of expected return, pushing leftward, trying to get minimum standard deviation or risk, and then they hit the end zone, right? I mean, when the offense scores a touchdown, that's the end of the story. And so in mean variance efficiency, they hit the efficient frontier. They can't move up into, what did I call that earlier? The unattainable region. So let's go ahead and take a look at this picture here. So we've seen this picture in previous recordings. So that green locus of points is the efficient frontier. So think of those offensive linemen. They're pushing as hard as they can, and they get to a barrier. And that barrier is the efficient frontier, which is the point where at every given level of expected return, risk is minimized. Now, one of the cool things about Harry Markowitz is you can take all those blue dots in there, the individual securities, and you can arrange them so that they fall in portfolios that are directly on the efficient frontier. That's probably one of the great reasons why Harry Markowitz won the Nobel Prize in economics. Now, I'm guessing that you're looking at that blue box and you're thinking to yourself, all right, Jim, what does this have to do with Harry Markowitz and the efficient frontier? So let's go back to our economics days. What do we know? We know that individuals are seeking to maximize their own utility, right? If I give you a choice between a Honeycrisp apple and a cup of Starbucks coffee, and you only have $5, right? You have that constraint. You're constrained by that $5. The apple costs $5 and the coffee costs $5. Well, you're going to pick. And you're going to pick between those two based on how much utility, how much satisfaction you get out of eating an apple. And I've used Honeycrisp apples in many recordings before. I always say this: a Honeycrisp apple is like biting into a steak. It's so good and juicy. Coffee, I've had less than 10 cups of coffee in my life. So there's no way I'm spending $5 on a cup of coffee when I can have a Honeycrisp apple. But many of you might prefer the coffee over the apple. So that utility function in blue is based on that marginal cost, marginal benefit that we learned back in our microeconomics days. Now, of course, it's a little bit different in the investment arena because we have to worry about expected return and standard deviation and risk. So look at on the left-hand side of the equal sign, you have the investor's utility for a given asset mix. So remember, we're in this context of asset allocation. So here's our satisfaction. So what do we want? We want lots of expected return, right? There's an implied positive sign in front of the expectations operator. But then we subtract out the penalty for searching for an expected return, and that penalty is risk. Now, you should be asking yourself the question, all right, what are all those things over there, Jim? So let me take a step back. This is not part of the learning outcome, but as a good academic, I feel compelled to tell you about this. One of the most appropriate utility functions that we use in finance and economics is an exponential utility function. And that works really, really well in times of uncertainty or in times of risk. So we're using this exponential utility, and then as we try to maximize utility, we have to take derivatives. And when you take a derivative, a lot of times you get a 2 in the denominator when you compute that first derivative. And that's what the 0.5 is. It's really 0.005. And by the way, the reading gives you an entire paragraph on when it should be 0.5 and when it should be 0.005. Excuse me. And it depends on whether the returns are in decimals or in percent term. I thought it was kind of interesting that they spent so much time doing that. So that 0.005, don't really worry about it. It's just a function of taking first derivatives in this exponential utility function, which, by the way, is a special case of the hyperbolic absolute risk aversion, which helps us define what our goals are. I mean, if I said to you, what is your goal in life? You might say you want to retire with $10 million in your retirement account. Well, that's an end of period wealth. And that's why we use this hyperbolic function. That's why we use the exponential function. So if you want to forget the last 3 minutes of your life, that's perfectly fine. But it adds some value, at least I think it does, in understanding this equation. And then lambda, that's just a measure of the degree of an investor's risk aversion. And I think in the previous recording, I mentioned that lots of practitioners and researchers say something like that parameter ought to be, it's probably somewhere between 0 and 10. And this reading actually identifies, look down at the bullet points there, 0 for a risk neutral investor, 4 for a moderately risk averse investor. And then it doesn't really say anything about what an 8 or a 10 means. But just think of lambda as, some kind of a scalar that reflects the slope of the indifference curves that each individual investor has. And then that final term is the variance, the standard deviation squared, given that particular asset mix. All right, so what are we trying to do here? We're trying to maximize our utility. So how do we do it? Well, we want lots of the first part, right? The expected return, and we want a little bit of the second part. This is an offensive lineman pushing and pushing. Now, this is what you should be saying. You should be saying, wait a minute, Jim. The LOS says describe and evaluate. It doesn't really say anything like compute or calculate or demonstrate. And I'll let you guys decide, but we're going to work through a problem here on this next couple of slides because the reading has a super cool example there, like the one that we're going to do here in just a second. But it also has, in its 18 problems at the end of the reading, there are 2 or 3 of these mathematical results. So the end of readings asked you to compute. The LOS doesn't sound like it does, but if I were taking the exam, I would make sure that I could solve this problem here. So let's go ahead and work through a quick example here. And hopefully you'll see how obvious this is and how easy it is to know how to do this on the exam. So here we have an appropriate asset allocation question, right? So we have an average risk aversion coefficient of 4. And then as a good financial analyst, we put together this table here. So the MVO statistics and allocations for A and B. So we have expected returns of 6 or 8 and standard deviations of 4.5 and 6.25. So you might look at this and say something like, okay, what is my risk averse investor like? Allocation A or allocation B. And you might want to try to do, maybe just some kind of a ratio there. Take 6 over 4.5 or 8 over 6.25. You might want to do that, and you might be tempted to do that. But let's go ahead and use this. Here, let me go back here. Let's use this investor's utility function to maximize the utility instead of just a simple ratio that we've probably done before. All right, so look down in the very bottom under the justification. So there's asset allocation A. So we take the 6 minus the 0.005. There's times 4, right? So those are those two after the minus sign. They're constant for allocation A and B, but then we're going to multiply by the 4.5 squared and the 625 squared, and we get allocation A 5.6, allocation B 7.2. So let's skip up there to the top. The solution is we should recommend allocation B because the expected utility 7.2 is greater than 5.6. So I think that this is a great exam question. Now, I will caution you that in the problem in the reading and in the examples at the end of the reading problems, that formula in the blue box is given to you. So I would suspect that if the institute asks this question on the exam, they would give you that utility function. How's that sound? All right, let's go back to Harry Markowitz and answer the question about what this mean variance optimization is on a more granular level than we did just 10 or 15 minutes ago. So what do we need? We need the returns. We did that before. We need the standard deviation. We did that. We need the correlations. But now we need a risk aversion factor, which we introduced in that previous slide. And then we need some constraints. There's the budget constraint and the non-negativity constraint. Now, what I wish I could do is take a few moments, and it would take just longer than a few moments, is to show you how I take my students through this process. And we use Yahoo Finance, and we download monthly stock prices into an Excel spreadsheet. We use the sum product function, and we use the solver function, so you can actually see the utility maximization and subject to the constraints. You can actually see those little windows. And then you hit a button that says solve, and what do you get? You get a change in the portfolio weights. And the way it works in Excel, and I think this is helpful for you guys to think about this, is that let's suppose you have 5 stocks. What you do is one of your inputs is an equal weighted portfolio. So think about a row. You have 20%, 20%, 20%, 20%, and 20%. So you have 0.2s in a row. When you hit solve, what Harry Markowitz will do and the solver function will do is it changes those 20% into the optimal weights. So one might be 11%, one might be 32%, one might be 4%, but those weights are going to be positive, right? There's a constraint, non-negativity, and then they have to sum to 1. It gives you those asset allocations, and then from those asset allocations, it will automatically compute the return on the portfolio and the standard deviation of the portfolio. So Excel is really, really cool. Now, let me pause here and get back to this LOS. That when I do it with my students in class, we use historical returns, and then that gives us a new historical return and standard deviation of the portfolio. What the reading is talking about is forward-looking. What we want to do is we want to have expected returns and expected standard deviation of the portfolio. So remember that in answering those questions. Now, we've done this before. I've said to you, hey, there are a bunch of these researchers that won Nobel Prizes in economics. And then I said to you guys that your question should be, okay, it's a Nobel Prize winning piece of work, so it's awesome, but what are its weaknesses? So there are a couple of weaknesses here that we're going to try to address. And so this is part of the last part of this LOS. So what don't we like about Harry Markowitz and his 1952 stuff? Well, this is what I know, and my students realize that if you have small changes to one of those inputs, like that return column and maybe the correlations, that you have dramatic changes in the optimal weights. So portfolio allocations are sensitive to small changes in inputs. In fact, what we could do is, if you guys are taking notes, you could probably add a word in there, are highly sensitive to small changes in inputs. Now, what happens is that what Harry Markowitz tends to do is they those allocations probably become highly concentrated in a subset of available asset classes, mostly because what Harry Markowitz does is he takes the correlation coefficient and he finds the lowest correlations out there, maybe even negative correlations, and then he lumps those together. And so those are highly concentrated in some area. We might not know what that area is, but in some area. I'll tell you another story that when my students do this with the non-negativity constraint, there are lots of their stocks that have 0.0001 allocation, which means Harry Markowitz is saying we don't like this stock, probably because it has high correlations with other stocks, and you get that same kind of return vector with just the one stock, and that stock that has very, very low allocation has almost no diversification benefit. Remember, those dudes back in the old days, they loved this concept of a normal distribution. And they said, all we need is the mean and the standard deviation, and that accounts for the entire distribution of returns. But we know that there's some skewness in returns, and we know that there's some kurtosis. So we need to account for that. So that's a big failure there. Now, the fourth one, that these allocations appear across these diversified asset classes and diversified assets inside of them. Remember I said that 20, 20, 20, 20%, they changed to 11 and 28 and 38, whatever I said. But the sources of risk might not be identified. In other words, we don't know if Harry Markowitz valued, let's say, inflation as a factor, or maybe he valued the strength of the dollar as a factor. So we don't really know what that source of risk is. And then this thing totally ignores the right-hand side of the investor's balance sheet. So it ignores the liabilities, and it's a single period framework. So remember I said to you about that, about the exponential function and then the hyperbolic. Remember I said those things? And those, what we're trying to do is maximize our end of period wealth. Well, that end of period might be 20 years for some people. It might be 2 years for other people. It might be 50 years for other people. So it's a single period framework, and it doesn't really consider intertemporal changes to the model. All right, so how do we address these weaknesses of the mean variance optimization model? Well, the simplest way to do this, and the reading does emphasize this, the simplest way to do this is to say something like, you know what, let me go out and buy every asset that's out there. Let's call this the global market portfolio, weighted sum of every asset in the world. I tell my students to think of it like this. Suppose that you went out and bought one share of stock, of every stock that's traded in the United States, in Canada, in Mexico, in Japan, in every country of the world. Well, that sounds like you would own the global market portfolio. That's a diversified portfolio. And then you could go out and buy one bond that's issued by all the governments and all the corporations out there. And then you could go out and buy one share of a hedge fund that's out there, and one share of private equity, and one share of movie memorabilia. So that's what this global market portfolio looks like. So look at the second point there. It represents a well-diversified asset allocation if you do this on a weighted sum. So don't think of it, it's okay to think of it as one share or one bond, but let's go ahead and weight those with those market values. So then what you can do is you can use that as a baseline approach. And that just throws away all the problems that we had in that last slide. And then what you do is that you adjust the concentration, the allocation, the investment in those individual assets according to the specific client needs. That's why we have specific client needs can deviate from that optimal global market portfolio. So think of this way as, a super broad stroke brushing of how to arrive at an optimal portfolio for a client. And so the reading then goes on to say something like, all right, let's go ahead and be more granular. Let's figure out how to solve this problem, those critiques of the MVO, with a more mathematical type of a model. All right, so what we're going to do is we're going to improve the quality of the inputs. We're going to resample, and we're going to add more constraints. So we're going to do those three things. So that's part of the recommend and justify and addressing those criticisms. So let's go ahead and talk about this reverse optimization. So the reading has a very interesting paragraph on how we start with reverse optimization. And really, reverse optimization is exactly what the name suggests. You optimize, but instead of, like in Harry Markowitz and Excel, having those 20% change to their optimal weights, you just assume that those weights that you're using, maybe those are market weights, market value weights of your portfolio, you just assume that they're optimal. And it goes to great lengths in a paragraph in the reading to say something like, hey, let's go ahead and assume. In fact, I think the word assume is written in italics in the reading. And you could probably come up with other ways to assume that that's an optimal portfolio, but then you just work your way backwards, right? So you calculate the expected return of the portfolio in line with those weights, and that becomes your imputed or the implied returns, which then are inputs to the traditional mean variance optimization strategy, and then you get new weights. So you start with what you think are optimal weights to come up with returns, and then you work your way through the regular old Harry Markowitz stuff, and you get a new set of weights. And so why is this important? This reverse optimization, what it will do is it will eliminate, I said a wrong word there. It will substantially reduce the result of a concentrated asset allocation because you start with an assumed portfolio weights that are based on things like market values. And so this reverse optimization strategy really gets down to some researcher, some analyst saying, you know what, the people on the floor of the New York Stock Exchange, they know what they're doing. So whatever those market weights are in the context of my client's portfolio, I'll just assume that they are optimal. So here's the process in a flow chart. So we start with that. Look at the very first light blue bullet point, an optimal asset allocation based on market weights. Then we just go through the whole process there, just like we did on that previous slide. Now, what we can do is that we can use the Black-Litterman model, which goes back to the early 90s, I think. And the Black-Litterman model, here, let me go back here real quick. So somewhere in this little flow chart, in this little circle, what Black and Litterman do is they inject a box that allows for us to consider the client's specific and unique items, right? Well, what's unique to the client? Well, the client might have specific behavioral issues. The client might have specific capital market expectations. And we have 2 readings on capital market expectations recently. So notice that this flow chart here looks an awful lot like what we just did. But there, can you see in the bottom middle, there's the Black-Litterman stuff. And what you can do is you can say something like, all right, look over in the bottom left. Here are the imputed returns that the reverse optimization provides us. And let me just pick a simple example. Let's suppose that Apple is in there, and Apple has an imputed return of, let's say, 15%. But what Black-Litterman does is say something like, well, you know what? We're doing tons and tons of research on Apple, and we like the iPhone, we like the new iMac, we like all these things, and we think the return is going to be not 15% but 17% because of all of these extra fundamental or technical factors. So the Black-Litterman model will allow an analyst to incorporate that into the process. So look up above at the orange arrow point, but includes investor expectations. Now the reading goes to great lengths to say something like this, and we always hated this when we were in graduate school, when an article we were reading in the Journal of Financial Economics or Journal of Finance would say something like, this particular article has this point here, and we're going to skip over the next details. And so you had to figure it out on your own. But what the authors of this article say is that the Black-Litterman actual mathematical input is far too explicit and extreme. It goes beyond the scope of this reading. So we're off the hook as readers of this and as test takers, so we don't have to worry about exactly how it gets in there. But if you remember that orange arrow point, you should be perfectly fine. All right, here's that second thing here. How are we going to add some constraints? Now, for those of you who know Solver in Excel, you'll know that when you minimize or maximize up at the top, and then you have subject to all these constraints, and you could put 100 of them in there. So what we can do, we could specify a fixed weight. We could say something like, hey, we want our allocation to Apple stock being 10%. So you just put that in a constraint. You could have upper limits, you could have lower limits, you could have asset weight corridors. I mean, you could put a constraint in there that says, okay, I don't want Apple to ever get above 22%. Or you could say, I allow Apple to be between 11% and 27%. Or you could say, I want Apple to be no more than 30% of the investment in Amazon, or whatever it is. So those first 1, 2, 3, 4 are just extra constraints that you can impose on there about the outputs, right? We're changing the 20% into different numbers, and you can just say, you know, Harry Markowitz, I don't really care what you come up with. I want Apple to be between 18 and 22%. And then the bottom one, hedging characteristics. I think this is fascinating. I don't know how fascinated the Institute thinks this is, but at least moderately fascinating. But let's go back to my example that I've used in previous recordings. You know, instead of doing the retirement goal, in previous recordings, I've said something like, you know, let's suppose we want to buy a lake house in 10 years. And so what might we do? Well, we might just take some of our portfolio and, you know, well-diversified portfolio. Harry Markowitz would say, here, put this in the context of your total returns and standard deviations and correlation coefficients. And at the end of 10 years, we'll see how much money you have. Now, if we use, you know, our hyperbolic and our exponential utility, we ought to be able to maximize that end of period wealth. But this thing here, an additional constraint, says something like, you know what? What I'm going to do is I'm going to tie my investment of that lake house to an asset that looks an awful lot like that. Maybe there's a residential lake house ETF. So I'm going to put some of my wealth today into that ETF. And as that grows, that's going to protect me against the increase in the value of that lake house over time. So you see that hedging. It's not a perfect hedge, but it could be a nearly perfect hedge if we identify those liability-relative settings. So you see how cool this is. You're looking at both the right-hand side and the left-hand side of the balance sheet. And here's a little trick. Remember now, if you want to buy that lake house in 10 years, you are naturally short in the lake house market because you benefit if the price of that lake house falls over time. So you take the long position in a lake house ETF, and so that protects you if the price of that lake house goes up, which of course it probably will, right? All right, how about that third one? Let me just go back here, make sure you guys are following along here. So we improved the quality of the inputs by doing the reverse optimization and the Black-Litterman. We added more constraints. Now we're going to resample the mean-variance optimization. Remember that these are ways to eliminate, to reduce that problem of concentrated asset allocations. So here we're just going to use Monte Carlo simulation. And let me skip ahead here. Oh, you know what? There we go. Monte Carlo simulation and scenario analysis. Now I'll come back to this, but I wanted to do this before I did Monte Carlo in that previous one. And by the way, you should have seen a slide like this in level 1 and level 2 when we talk about Monte Carlo. So what do we have for Harry Markowitz? We have the returns, we have the standard deviations, and we have the correlations. And then we also have lambda, right, our measure of risk aversion. And then if we're using that utility function, maybe we have the 0.5, or maybe we're using some other function. So I want you to think of those things as the inputs. What Monte Carlo simulation will do is it'll generate random numbers about the means of each of those inputs, right? And then what it will do is that it will run this over and over and over again, tens of thousands of times, maybe 100,000 times. All right, so let me hold off on that and go back to this slide here. So we're going to generate random variations of those inputs. And what are the outputs? The outputs are going to be, instead of just one row of optimal weights, we are going to change those inputs, and we're going to come up with, let's say, 100,000 of possible asset allocations given the context of all of our inputs. What did we start with? Look at that top left, basic mean variance optimization model. So then what we're going to do, we're going to take the averages, just like we do, and we're going to draw one of those distributions. So we might draw a normal distribution, in which case we could say, hey, thank you, Monte Carlo. That was really a great extra exercise and costly exercise. But Harry Markowitz took care of that because he assumed that we could solve this problem using means and standard deviations. But what do we know? We know that skewness and kurtosis exist in stock returns. So this Monte Carlo simulation, and here's the answer to the question here, it incorporates skewness and kurtosis into the utility function. So we can use this then to do things of value at risk, or maybe expected exposure, or any of those other kinds of risks that we talk about in the other readings. So Monte Carlo is really cool because it helps us solve the problem of highly concentrated issues, which are mitigated when you allow, therefore, skewness or kurtosis. Remember, Harry Markowitz assumes skewness and kurtosis are zero. Remember I said to you that there's a lot of commonalities between this reading, which is the middle one, and the first one, and the last one, which we'll go ahead and do shortly. We advance our regular old individual or institutional balance sheet into what's called an economic balance sheet, which includes non-tradable extended assets and liabilities. So think about extended assets as human capital. Think of extended assets as the present value of an inheritance. Think about it as maybe residential real estate. Think of extended liabilities as maybe the present value of future consumption. And so look at the second diamond point. Many asset allocations based solely on financial assets are probably too conservative. And I lived through this with the passing of my parents. My parents did not have a lot of money when they died. They were very, very humble. My dad was a private school educator. My mother was a bus driver, but she was the greatest bus driver that ever lived. Boy, all her kids loved my mother. So when they passed away, they had their house and they had some savings, and so my sister and I shared in that. So all of a sudden, I feel like I have more money than I did before, but I could have taken more risky positions, let's say 20 years ago, because of taking the present value of my inheritance. Of course, that would have been assuming that my parents loved me equally with my sister. My dad always threatened to change his will depending on which one he loved us more during that particular day. Of course, my father was just kidding. So how do we model this? So this is cool. Model human capital as an inflation-linked bond. Model human capital as a combination of equities and corporate bonds. And you can do that for both the left-hand and the right-hand side of the balance sheet. Let's just use tradable financial assets because they have higher correlations. I don't want to say high. I don't want to say correlation coefficient of 1, but they have higher correlation coefficients so that we can model these and we can use a tradable asset to help us make these asset allocation decisions. And so look at that example down the bottom left here, modeling residential real estate. This is what I was talking about just a moment ago. If we wanted to buy that lake house, well, let's go ahead and buy, what did I say, a lake house ETF. The reading uses the concept of a real estate index, but you get my point. Here's a slide that I should probably just go right through quickly, but I won't. I'll go through it really quickly, but not super quickly. We know this even before we entered the CFA program, right? Asset allocation can be complicated by illiquid assets. You might remember me telling you the story of Steve Martin, the famous comedian and actor. Years ago, he spent a couple $100,000 on what he thought was an original painting by an original artist. It turned out to be a forgery, and so here we go. That's illiquid. Even if it wasn't a forgery, how often do you sell? I mean, Steve probably bought that asset. He was probably going to hang it in his living room for the rest of his life. Now he could decide to sell it, or he could leave it to his heirs, and they could decide to sell it. But clearly, that painting, whether a forgery or not, has less liquidity than a share of Apple stock on the stock exchange. Same is true with real estate. Same is true with infrastructure projects. Same is true with private equity and hedge funds. And so the problem is how to track these kinds of assets, because there's really not an accurate index out there. Although there is a really, really cool index out there for collectibles. And I urge you to go look at that when we have our conversation on alternative investments. I'll probably bring that up in a later reading. So how do we deal with liquidity? Look at here. We have 1, 2, 3 possibilities. Let's just exclude liquid assets from our asset allocation, but substitute a lake house ETF in there. What we could do is we could include these less liquid asset classes and try to model their specific risk characteristics and find more liquid assets that are tradable as substitutes or proxies in our portfolio. Or the third one over there, we could include these less liquid assets and try to directly model the inputs into highly diversified characteristics, which might include some kind of a factor model. So number 2 might be kind of a general factor model. Number 3 might be kind of a super specific factor model. Now here's something that we haven't done in a previous reading. So this is probably important here. Let's talk about risk budgeting. And so what I want you to do is think about this. Let's suppose we have 10 stocks, and here's the standard deviation of our 10 stock portfolio. Let's just suppose it has a 20% standard deviation. Well, clearly those individual standard deviations might be 12% and 40% and 30%. So, you're not going to add those up and be able to take a ratio. But what we want to do is we want to find a way to allocate each individual risk. We have 10 of them there, each individual risk as a ratio of the total risk. All right, and we do this through absolute and relative risk budgets. So what this risk budget is going to allow us to do is we're focused solely on risk. What we're going to say is something like, this particular stock, let's just say it's Apple, since we've been using that example, this particular stock has this much absolute and this much marginal or relative risk in terms of the context of the total portfolio. And let's go ahead and compare that ratio. And that's really what we're doing here. So look at that second embedded bullet point. A risk budget is optimal when the ratio of the excess return to marginal contribution to total risk is the same for all assets. So let's go ahead and define this. So marginal contribution to total risk. Look at the formula there down on the bottom of the slide. All we're doing is we're taking the beta of the asset class times the portfolio standard deviation. So that's a super easy calculation. And that's what I was trying to say earlier about here's our total standard deviation of 20%. We can't say if Apple has a 40% standard deviation, we can't do 4 over 2. That doesn't make any sense. So this is how we handle it. We take the beta and we multiply that by the portfolio standard deviation. And so look at the definition, that orange diamond point. The rate of change of risk with a small change in the current weights. So if you go back to my original Harry Markowitz example, what did I say? That 20% might turn into 11%. So that was we went from 20 to 11. Well, let's suppose we just go from 20 down to 19, right? Small change in weights. Well, what does that mean for the contribution of that particular stock? In this case, I used Apple, but in the reading, it's the entire asset class, maybe technology stocks, right? Now, what we then want to do is we want to get this absolute contribution to total risk. And that's going to tell us how much that asset class contributes to the total volatility of portfolio return. This is the specific one that I was trying to get at a little bit earlier, right? So all we're going to do here, look at that equation in the middle. We're going to take the asset weight and we're going to multiply it by and I'll just go back here real quickly, the marginal contribution to total risk. So we're taking the beta times the portfolio standard deviation times the asset weight. All right, so you think about columns there, and you just are going to multiply those three columns, and we're going to get that absolute contribution. And then we're going to do this ratio that I told you about just a few moments ago, and I'll save that definition here for you here in just a second. So let's take a look at an example here in this table. So we have three asset classes: equities, bond, and cash. So 52, 34, and 14%. Of course, those weights sum to 100%. And then through some good research, we come up with these excess returns of 657, 285, and then of course cash has 0. And that portfolio excess return is 4.38%. Boy, at the risk of offending you, how did I get 4.38? All I did was take 52% of 657 and 34% of 285. That gets me the 438. All right, there are betas given to us there, 1.5 for equity, 0.65 for the bond, and then the beta of our portfolio, well, that's 1 if you do the same math that I just did before. All right, so that stuff is kind of given to us in the problem. The question then is, let's go ahead and let's do let me go back here quickly. Let's do the marginal contribution and the absolute contribution to total risk. Now, to do this, we need to look down at the bottom of the table. Portfolio standard deviation is 13%. I guess we could have put another column in there and shown how we calculated those, but I don't know that we needed to do that to identify and solve the LOS. All right, so what are we doing back here for the marginal contribution to total risk? We're just taking the beta times the standard deviation. So take 1.5 of 13, that gets you 19.5. 65% of 13, there's 8.45. All right, so everybody see that marginal contribution to total risk column should be able to compute that. Then what we're going to do is we're going to compute the absolute contribution to total risk. All we're doing now is taking the asset weight, there's the 52 and the 34%, times that marginal contribution. So, do the math there. Half of 19 is about 10 and a third of 8 is about 2.9. So there's our absolute contribution to total risk. Oh, look, that's 13%, right? There's our portfolio standard deviation. If you sum those absolute, well, it should make sense that you get 13%. But then remember, what we're trying to do is we're trying to figure out how to use this risk budgeting process to determine if we have an optimal portfolio. So now we're going to do that ratio that I was saying earlier, the percent contribution to total risk. Let's just take our 10% divided by 13%, that gives us 77. 2.9 divided by 13, that gets us 22. So they have to sum to 1. And then that ratio of excess return, we're going to take our expected return minus the risk-free rate of interest rate divided by the marginal 1. So you get 1/3 or 33.7, right? So 0.337. Wow. So those two things, they're the same number, right? 333 and 333. They're the same number, which, let's go to the very bottom there. Wow. The portfolio Sharpe ratio, which was 438 divided by 13, right? Well, that's the same number we got on the right-hand column of the table. So it's equal, which tells us that that 52, 34, 14 allocation is optimal from a risk budgeting perspective. So you see how this risk budgeting, when we do marginal and absolute, that adds value to our asset allocation. So let me just go back here real quickly. So let's just suppose that the 52, the 34, and the 14%, that those weights were derived from any of those ways that we just did in the previous, 30 or 40 minutes of this recording, the Harry Markowitz or the reverse optimization or the Black model or whatever that model was. What do we decide? Hey, this is optimal. All right, moving on to how client needs and preferences. All right, client needs and preferences, they sound an awful lot like they are qualitative. So the question then becomes, how can we, as good students of math, right, how can we turn that qualitative factor into a quantitative factor? And so that's what this slide does here. So we can just add additional constraints. We can say a risk-averse investor could specify a limit. We could put a constraint into solver that says something like, look, we have a client here who really doesn't like risk, has a lambda of 6 or 7 or 8. So we don't want anything above 20%. That's the example. We could even use Roy's safety. Remember that was a ratio of the expected return on the portfolio minus a minimum acceptable rate of return. So there's safety first criteria or some other restriction. So notice the last bullet point there helps express in a mathematical way what an investor prefers or requires. Now, we've already done this risk aversion parameter, so we can do this based on any kind of utility. We did the exponential utility. That's kind of the implied traditional economics and finance way, but you could come up with your own utility function. I could help you derive Jim's utility for a client who does this and this and this and this and this. And then we've done Monte Carlo simulations. So notice what we have in bold: realistic and possible total wealth outcomes. So what did I say earlier? I said, let's suppose that we want to retire with, what did I say, $5 or $10 million. What Monte Carlo will allow us to do is look at all of the different paths to get to that total final wealth. And so this adds value to our understanding. So let's go ahead and redo this slide, which I did earlier. Random number generator. We did this single period output. But what we can do now, back in this context, which is a little bit more broad stroke than the context that we talked about earlier, portfolios, we know that these are going to change over time, right? They're dynamic. And so what about interest rates? What about tax rates? What about exchange rates? What about inflation rates? And so what we know is that we can use this Monte Carlo simulation over and over and over again to develop a strategic asset allocation and extend it to a multi-time period horizon. And so, mean variance and value at risk and beta and all these different models that we use for risk, they tend to be reliance on single period time frames. But I assure you that if you do some research into the academic world, there are tons of models out there that are called intertemporal models. That just means, kind of over time. So that's what Monte Carlo here is helping us do, is to find out, okay, what are the different time periods that we need to consider before we get to that end of period wealth. Yeah, we can incorporate trading and rebalancing costs. And we'll talk about rebalancing at the very end of this slide. Look at the last one there. I like that. Complements mean variance optimization by addressing its limitations. So how do we do this? Boy, we can define realistic limits on those inputs. We can go through thousands or tens of thousands of iterations, and we can randomly generate a path so that, just think about a graph that has time here, right? And end of period wealth here. And so you can see this, okay, so periods of inflation, well, I should go the other way. Periods of high inflation, our portfolio goes down. Periods of economic expansion, our portfolio value goes up. So you can visualize this with Monte Carlo. All right, I said earlier that we can use factor models. We've done factor models before. So let's go ahead and decide how we can use factor models inside of the asset allocation model, which includes all that Harry Markowitz stuff and Monte Carlo simulation. All right, so What are some investment factors? Look at that very third embedded bullet point. Liquidity, credit rating, specific sector or industry, market exposure. I don't know, maybe we have beta for market exposure. Maybe we have some other measure of covariance. Volatility, if that's total risk. Duration, expiration risk. Oh, if we have some fixed income security that has, some kind of an embedded option, etc. So how do we do this? Well, Eugene Fama and Ken French, they came up with this model, decades ago. This is the Fama-French multi-factor model. And what Fama and French decided is that the capital asset pricing model, while a Nobel Prize winning piece of work, these two guys decided that model puts a lot of pressure on beta, right? What does beta do? Beta is our measure of systematic risk. How do we define systematic risk? It's the variability in stock returns due to changes in economic factors. So beta, this one little standardized random variable, is supposed to capture for a company like Apple how sensitive Apple price is to things like change in the value of the dollar, things like wars in different countries throughout the world, changes in inflation, spikes in oil prices. That's a lot of pressure on one little thing. So Fama and French said, well, there's some other things out there that can explain returns. And he called those risk premiums. So here's his model. So that first part on the right-hand side of the equal sign is the old capital asset pricing model. So Fama and French say, oh, yes, capital asset pricing model is still super important. Beta 1 in this case here, it's still super, super important. But notice there's a plus sign over there. So we're going to add a size premium because Fama and French know that small firms outperform large firms. And then there's a plus sign. This is the value premium. So Fama and French know that value firms tend to outperform growth firms. So what we're going to do is we're going to have an asset allocation model based on three factors. We're going to hold the market portfolio. Look at the bottom. We're going to be long in small stocks and take the short position in large stocks, size premium there in parentheses. And notice this is a $0 portfolio. So all of the income that we generate by shorting the large stocks, we're going to use that to buy all of the small stocks. So it's a $0 portfolio. Then we're going to take the long position in value stocks and the short position in growth stocks, right? We define value as high book to market. We define growth as low book to market. This is the value growth premium. So once again, this is a $0 portfolio. We're taking the income from the short positions. We're going to use that to buy the long position in the value stock. So what Fama and French showed is that this portfolio here that has the market portfolio plus a $0 size portfolio and a $0 value portfolio, this portfolio outperforms. So clearly these factors are relevant and they're appropriate to use in the context of all the stuff that we've done in those previous slides. All right, the next LOS is building on what we talked about in that previous reading. What we're concerned about is that up to this point, with the exception of some hedging that I talked about with that, what did I call that? The lake house ETF, we've been focused on the left-hand side of the balance sheet. So now we want to talk about the relevance of liabilities in asset allocation. So what do we know? Well, in my example, I said, well, we want to buy a lake house in 10 years, right? Well, let's suppose that we sign a contract today saying, I promise to buy the lake house in 10 years. So there's a fixed cash flow. Maybe it's legal. Look at that purple one. Maybe it's quasi-legal. Maybe we're going to use the duration and convexity of a bond to help us fund that future obligation. Now, that future obligation, it could be contractual or it could be just, something that we want, right? Now, look at that top one. Those cash flows could be fixed, which is kind of what I was saying earlier about buying a lake house, but it's contingent on probably what inflation is in that particular lake house market, right? So we need to consider the contingency element. I mean, that's not really an embedded option, but maybe our liability has some kind of an embedded option because maybe it's tied to real estate and there might be some chance that somebody refinances their mortgage. Now, what we can also do is we can take a look at those liabilities as a percentage size of the overall balance sheet. This is probably more relevant for institutions, but we can consider other factors, right? Inflation, economic conditions, interest rate, risk premiums. We can consider other factors on top of what Fama and French taught us, and those extra factors then are related to the right-hand side of the balance sheet. So timing considerations, that's probably slightly captured back here with duration and convexity, but you may want to consider the actual maturity date of the bonds or the actual longevity. And then maybe there's some regulations that are out there as well. All right, so compare liability and asset approaches. So look down at the bottom first. Techniques like mean variance come up with optimal asset allocation. However, the liability-relative approach takes a look at what are we doing on the right-hand side of the balance sheet that we either know is a contractual liability sometime in the future, or maybe we just want to buy a lake house. Then we use that as an input over here to allocate on the left-hand side of our balance sheet, right? All right, we do this three ways. Hedging return-seeking portfolios. This is exactly what I was talking about before. Or we can do surplus. We talked about the surplus in just this very recent recording. So let's do that first. So surplus optimization. So you have an institutional fund like a pension fund. And so let's suppose that the present value of the liabilities is 10 and my present value of my assets is 12. So I'm fully funded, right? I can do 10 equals 10, but then I have 2 left over. So then I can manage that 2 as a surplus, and I can just apply Harry Markowitz and the mean variance optimization, or I can add Monte Carlo to that. So I'm just going to manage that surplus. So I can draw my own efficient frontier based on that surplus. So look at this, the idea with the surplus return. First, satisfy the liabilities. That's why I was saying 10 is equal to 10. And then that excess value of 2, we view that through the lens of mean variance optimization. And then you can compute a return down there if you want to. You can even use our objective function that we implemented before. If you do all this stuff, here's just some steps. We've done this many, many times throughout level 1, level 2, level 3. So the surplus is just being used as an approach. It uses the mean variance optimum approach. All right, how do we estimate expected returns and variances of liabilities? Well, we just find stuff like I said before. We find bonds or equity securities or ETFs that look an awful lot like our liabilities. And you can use the factor approach to do this, as I've said before. What we can do here is we can do the hedging return-seeking portfolio. So we can choose a surplus amount like $1 out of that $2, and we can manage that. And then we can take the other $1 and we can say, hey, let's just go ahead and maximize return-seeking approach. Yeah, so that makes perfect sense. So here, let me go back here and read this. So the objective of the hedging portfolio is to hedge the liability stream, and then the remaining funds are the second portfolio. What we can do is we can partially fund, or we can seek to change maybe the policy statement in the future to either add or subtract to the surplus. This is an aggressive approach. Boy, if you have a funding ratio that's less than 1, right, this is no good. Creating a hedging portfolio completely hedges the liabilities. It's not challenging. It's just not mathematically possible. And the reading does mention some kind of natural disasters there. And then the integrated asset liability approach, this is just a combination of those two. So I tell you this probably once a recording, go ahead and get out your cameras and take a picture of this. Here's a good summary of these two LOSs and what we just talked about. All right, how about if we're looking at individual investors and a goals-based approach? So let's suppose that we want to buy the lake house in 10 years. We want to retire with $5 million. We want to send our children who are, 2 and 3 and 4. We want to send them to an Ivy League college. And then what other kind of a goal we could have? You could have a goal like my father always did. He would always tell us, he was like, hey, I went out to dinner the other night and I had a hot dog because I didn't want to buy a steak because I wanted the two of you, my sister and me, I wanted the two of you to have more of my money when I die. So maybe there's a bequest function in there. So there are 4 goals-based approaches. So what can we do? Well, in the Harry Markowitz context, we're just going to throw all of our assets into the portfolio and then just hope, is that the right word? Hope that those 4 goals are met. But you see, the problem of that is with timing. And so what the reading does is say, look, let's have a portfolio for this, a portfolio for this, a portfolio. So these are called numerous sub-portfolios that are they're still formed in the context of mean variance optimization. You can still use Monte Carlo simulation, but each sub-portfolio is designed for a single goal with its own unique time horizon. Now, let's put a comma there and say, all right, there's probably going to be some issues with this, maybe some behavioral issues as well. I mean, my dad had a behavioral issue. I mean, my sister and I, we would say to Dad, please, will you get the lobster? Will you get the steak? We're both successful people. We have money. The fact that you spent $1 on a hot dog versus $10, that $9 that you saved, it's not going to change our lives. But my father insisted. So he had some, he had an emotional bias, right? It wasn't a cognitive error, but it was an emotional bias because essentially he loved us so much and he wanted us to be happy with all of his money when he passed away, which was, source of comedy for us for many, many, many years. All right, so here's a summary down at the bottom of what I just said. Address the goal, right, independently, but in the context of risk-return stuff. Oh yeah, figure out taxability, that's important. And then using minimum expectations instead of traditional average return expectations. So that's minimum expected. So you want to say something like, look, I want to buy this lake house for a minimum of $3 million. So that makes sense there. So what the reading does is tell us that these are the creation of portfolio modules. And so the only way we can do this is that we can match the goals to the appropriate sub-portfolio. So what do? Describe the client goals. So we do this when we interview the client, right? We get all those goals. We rank them, and then we probably rank them in order of their importance in terms of the client's importance, and then we probably rank them over a time period. Maybe we do duration. Construct these sub-portfolios, then that forms the overall portfolio, and then we're going to revise and revisit over time. Remember, the Institute is always big on monitoring and then making adjustments as those dynamic changes occur that impact those sub-portfolios. Think about our lake house. Suppose that this lake is built on, from a river that was dammed up, and there's a flood, and so this whole side of where you wanted to live, that's all flooded, and those houses are now 10 feet underwater. Well, that's probably going to impact the housing prices on that particular lake. All right, how about a goals-based approach? This is a super simple example here. I'm not sure how much value there is to doing the math, but we have portfolio A and portfolio B. We want to buy a ski chalet, right, in 30 years. And so notice down the left-hand column, we have expected returns and standard deviations like we have had always, but then we identify success rates. All right, so what we're trying to do is say, what is the client's attitude towards risk? Do you want a 100% success rate? Do you want a 75% or 90% or 22%? So if the client says, I want a 100% success rate, then you just go out and buy 30-year treasury securities and you move on with your lives. But you have different portfolios with different returns and standard deviations. So in this case here, at a 90% success level, portfolio B has the highest expected return. So there's an obvious question there. All right, we're getting to the end here. Heuristic and other approaches. All right, what do heuristics mean? It means just taking a shortcut, right? Rules of thumb, simple or generic rules. Look, we don't have time. We don't have time to go out and do all this stuff that the CFA Institute is requiring us to do. Now, when I say we don't have time, I mean we as the investors. But we, as in you and me, we have time to do this as a well-compensated financial or wealth advisor. But the investors, they don't have time to do this. And remember, when we did the behavioral issue, there are still behavioral issues for wealth managers. So we're susceptible to taking these shortcuts. But investors have limited skills. This institute is requiring us to have lots of skills, right? We have lots of understanding. We have, in the financial services industry, we have lots of resources and lots of information. But of course, our clients don't. So we take heuristics, we take shortcuts out there to minimize our efforts and to maximize our time spent on leisure activities. So what are some of these? We can take 120 minus your age. You probably have heard of that many times before. Here's an example. 30-year-old investor would allocate 120 minus 90, minus 30. That gets us 90% of our portfolio allocated to equity securities. This is tied into those target date portfolios. You know, as a professor, we use the TIAA CREF as one of our retirement choices, and so they have all these target date funds, and so that's what that thing is. You can do 60-40. That's a simple one, right? You can do the endowment model. This comes out of this name comes out of, it was originally the Yale Endowment Fund model. You might know that Yale's endowment, it was among the first to invest in private equity and real estate. And so because it was a long-term model, right, an endowment fund, college endowment, it didn't really need to have tons of Apple stock, and it didn't really care that Apple went up today and down tomorrow. It wanted long-term growth. Risk parity, what we know is that this MBO diversifies risk across asset classes, but not necessarily across the sources of risk. So this is what we were talking about with the factor models, but what we can do is we can take shortcuts into the factor models. We can say something like, oh, I don't want to be exposed to inflation at all. And so instead of using the Fama-French model, the extension of that model, to have exposure to that factor, we just say, all right, let's just not invest in any stocks that fall by substantial amounts when inflation is greater than, pick a number, 2% or 4%. 1 over N rule, I'll just let you guys interpret that. And here's the last one here. Rebalancing policy. So the Institute tells us, hey, of course, we want to revisit, we need to document, and we need to monitor, and we need to rebalance. So the question is, of course, marginal costs versus marginal benefits. Rebalancing is not free. And so there are costs of doing this. And so we need to ask ourselves the question about transaction costs, including things like taxes. And we need to ask ourselves the question about bid-ask spreads. We need to ask ourselves the question about how have correlations changed over time. So this LOS can be summarized in that bottom right block down there. So the effect on the optimal width of a corridor. So remember, we're doing asset allocation. So what did I say earlier? We could put in a constraint for Apple allocation of, what did I say, between 18 and 22%. So we're trying to find the width of that optimal corridor. So what are we going to say? Higher transaction costs, let's go ahead and say 17 to 23. Higher risk tolerance, let's go ahead and say 16 to 24. Higher correlations, let's do, boy, what are those numbers here? Can you see my hands? So that's a summary of rebalancing issues here. And I think that takes us through all of the learning outcome statements. So I'm going to say something to you. Hopefully you like this. What I want you to do is I want you to go ahead and compare the LOSs here with the LOSs in the previous reading and the LOSs in the follow-up reading. And those LOSs that sound like they're very similar, boy, they sound like they're going to be more important if they show up in 3 readings. Now for this reading, make sure you can do the absolute and relative risk budgets. Make sure you know about Harry Markowitz and mean variance. Make sure you know about Monte Carlo simulation. So thanks for watching. I want you to go to the end of reading problems. I think there are 18 of them there, and there are a bunch of good problems. And then go to our problems to, as always, to add value to your study. So I'll see you next time very shortly with our final asset allocation reading. Hey, I had fun today, and this, how long did this take me? Let me look at my clock here. Boy, that's over an hour, so hope you didn't fall asleep here. I had fun, and good luck studying.